Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. This is the last video on theory of this techniques of capital budgeting. First video I have explained you about what is the meaning of the term capital budgeting, what is the importance, and then I have explained you about the cash flows and incremental cash flows, effect of taxation and uncertainty in capital budgeting decision. All these things I have explained in the first video. Second video I have explained you about the evaluation techniques, how to evaluate the capital budgeting proposal. So all the techniques are broadly classified into two categories. The first, traditional techniques, undiscounted techniques, that consist of PBP and ARR, payback period and accounting rate of return, that I have discussed in the last video. Then the remaining three methods are modern methods, discounted techniques, and the three discounted techniques are NPV, net present value, PI, profitability index, and IRR, internal rate of return. These three are the modern methods. In the last video, I have explained you about NPV. Now in this video, I'm going to explain the remaining two methods, that is PI and IRR. If you have not watched the last video, I suggest you go to the playlist of my channel, select the subject Financial Decision Making 2, select the video of capital budgeting. Be perfect regarding the concept, regarding the terminology, and regarding the methods, how to evaluate the capital budgeting decision. So before going ahead, take the screenshot of the points which I have written on the board. Then I'll explain about the PI method and IRR method in detail. Now, the second discounted technique is PI. The first is NPV. So here, profitability index. Another technique, time adjusted capital budgeting technique, is the profitability index or benefit cost ratio. The other name of PI is benefit cost ratio. So we can call it as PI method or BC method, right? BC ratio method. It is similar to NPV method. This profitability index is very similar to NPV method. In net present value, NPV, we have subtracted PV of cash inflow minus PV of cash outflow. That is the formula for NPV. And PI is the ratio. Profitability index is the ratio of PV of cash inflow divided by PV of cash outflow. So there we have subtracted. Now PI, we are dividing PV of cash inflow divided by PV of cash outflow. It is similar to NPV. PI approach measures the present value of return per rupee invested. For every 1 rupee of investment, how much return we are getting in terms of cash inflow. Now, when NPV is based on the difference between PV of future cash inflow and PV of cash outflow. In case of net present value, it shows the difference between PV of cash inflow and PV of cash outflow. It was observed that a major shortcoming of NPV method is the being an absolute measure. One of the major shortcoming or disadvantage of NPV method is it's an absolute measure. So this method will be suitable only when the life of the projects are same, when the investment cost is same, but in reality the cost of the projects are different. When the initial investment of different projects are different, then NPV method is not the right criteria. This profitability index is the right criteria when the investment required is different for different projects and the life of the project may also be different. In that situation, NPV is much better than PI method is much better than NPV method. So, being an absolute measure, it is not reliable method to evaluate projects requiring different initial investments. If the initial investments are different for the projects, NPV is not the right criteria. Now, the PI method provides a solution to this problem. So, Now you can understand the profitability index is better and reliable only when the project's costs are different. When the initial investment required for A project, B project, C project, all the different projects are different. Now, in other words, it is a relative method. The NPV method is an absolute method, whereas this PI, Profitability Index method, is a relative method. It will be defined as the ratio. Now, definition of PI. What is the definition of Profitability Index? It is a ratio of present value of cash inflow by present value of cash outflow. So, the formula for PI is PV stands for present value of cash inflow divided by present value of cash outflow. Now in the next video we'll start the problems on all these methods. So you have to remember what is the formula for PI, Profitability Index. Apart from that, in examination you may get a theory question regarding explain about PI, Profitability Index. So whatever I'm explaining right now, the same thing you have to write regarding PI. Now this method is also known as BC method, BC ratio. B stands for benefit, C stands for cost. Ratio of benefit to cost, because in numerator we are taking benefit and denominator we are taking cost. That's why it is also called BC ratio. Using the PI, the project will be accepted if the PI is greater than 1. Now, how to take the decision whether the project should be accepted or rejected? Calculate the PI by applying this formula. If the PI is more than 1, accept the project. If the PI is less than 1, reject the project. If the PI is exactly equal to 1, that means indifferent. Whether you accept or reject, both ways same. The selection of the project with PI method can also be done on the basis of ranking. If we have more than one project, different projects are there, we can give the ranking. The highest PI, that project will be given first rank. Highest PI among all the projects will be given first rank, like that. Now, NPV versus PI. In examination, we may get a theory question like, what is the difference between this PI and NPV? So in most situations, the NPV and PI as investment criteria provide the same accept reject decision because both methods are closely related. Now see, NPV and PI, both the methods will give the same decision in most of the cases. NPV as a decision criteria will be adopted if NPV is positive, accept. If NPV is negative, reject. If NPV is equal to 0, indifferent. Here also same thing, NPV NPV greater than 1, accept. NPV less than 1, reject. NPV is equal to 1, indifferent. PI. PI greater than 1, accept. PI less than 1, reject. PI is equal to 0, indifferent. So in most of the situation, NPV and PI will give the same decision. The only difference is that NPV method indicates absolute figure, whereas PI method gives you a relative figure. For every 1 rupee of investment, how much return you are getting, that will be given by PI method. Now, generally the NPV approach is preferred when there is no problem of capital rationing. Capital rationing means limited capital. If only limited capital is there, it is called capital rationing. So if a company is facing the problem of capital rationing, then PI method will be more suitable. If there are no problem of capital rationing, the company will have unlimited capital, huge capital. In that case, NPV method is preferable. So normally, most of the businesses will face the problem of capital rationing. So PI method will be more suitable. That's it. So I have explained you about the PI method and comparison of NPV and PI. Now, the last and final technique of evaluation is internal rate of return. This is also very important from problems point of view. In the next video, I'll start the problem where we will calculate NPV, IRR, PVP, ARR, PI, etc. So internal rate of return. Like NPV method, the IRR method also considers the time value of money, because these are discounted techniques. NPV technique, PI technique and IRR technique, all the three are discounted techniques. Means these techniques will consider the time value of money. The IRR is usually the rate of return that a project earns. Actually, internal rate of return is the rate of return which the project earns, right? Now, the IRR is usually it is defined as the discount rate. Now concentrate the definition of the IRR. IRR is the discount rate which equates the aggregate of PV of cash inflow with the aggregate of PV of cash outflow. Aggregate means total. So IRR is that discount rate at which the aggregate of PV of cash inflow will be exactly equal to the aggregate of PV of cash outflow. In other words, it is the rate at which the project's NPV will be 0. When inflow and outflow both are equal, then what will happen? The NPV will become 0. So in other words, you can say like this: internal rate of return is that rate of return at which the NPV will be 0. Net present value will be 0. So IRR is that rate of return at which discounted cash inflows are equal to discounted cash outflows. This definition is also very important. Internal rate of return is that rate of return at which the present value of cash inflows is exactly equal to the present value of cash outflow. The use of IRR as a criteria to accept or reject capital investment decision involves a comparison of actual IRR with the required rate of return. The management will say the required rate of return, that is the cutoff rate, cost of capital. The company's cost of capital, let it be 20%, that is the required rate of return. The management says any project whose rate of return is more than 20%, that should be accepted. Because our required rate of return is 20. Now calculate the IRR of the project. If the IRR of the project happens to be 25%, accept the project. If the IRR of the project happens to be 15%, reject the project. Because we are comparing that IRR with the required rate of return. In this way we take the decision. Now the project would qualify to be accepted if the IRR, in abbreviation form we call it as R, exceeds the cutoff rate. Cutoff rate means cost of capital. It is abbreviated as K. If R is greater than K, accept the project. Internal rate of return is more than the cutoff rate, accept the project. If the IRR and the required rate of return are equal, the firm is indifferent as it is whether to accept or reject. If both are equal, the internal rate of return and the cutoff rate, cost of capital, both are equal. In that case, the company is indifferent whether to accept or reject. Now, advantages. What are the advantages of this IRR? The first advantage, it considers the time value of money. The main advantage of PI, NPV and IRR, all the three methods, the main advantage is these methods will consider the time value of money. That means the value of money will not be same every year. Every year the value of money will change. So considering the time value of money is the main advantage of IRR. Second, considers the cash flow for the entire life. In some methods, the cash flows of the entire life will not be considered. But in IRR, we consider the cash inflows and outflows for the entire life. Third, it is consistent with the objective of maximizing the wealth of shareholders. The main objective of financial management is to maximize the wealth of shareholders. So if IRR method is followed, it is consistent with the main objective of financial management of maximizing the wealth of shareholders. These are the advantages. But disadvantages are difficult to understand or operate. It is not as easy to calculate NPV or PI. So if you compare the IRR with NPV and PI, IRR is more difficult to calculate. Number of steps are required to calculate the IRR. It's not so easy. Difficult to estimate the future earnings accurately. IRR requires the future earnings to be calculated, and it is difficult to calculate the future earnings. It assumes that intermediate cash inflows are reinvested at the internal rate of return, but it may not always be true. One of the assumption of internal rate of return is the intermediate cash inflows. Every year what the cash inflows are there, those cash inflows are reinvested at the rate, that the internal rate of return. But normally it is not possible. The reinvestment rate may be different from the internal rate of return. That is a disadvantage. So these are the advantage and disadvantage of IRR. Now calculation of IRR. How to calculate the IRR? Two methods are there. You have to see whether annual cash inflows are constant or fluctuating. So two separate formulas are there. So first I will explain you the steps when annual cash inflows are constant. So in the problem you have to see whether annual cash inflows are constant or fluctuating. If it is constant, first step, determine the PBP, payback period. The payback period formula, initial investment divided by constant annual cash inflow. Already in the last video I have explained about PBP. So same here also, first you need to calculate PBP. Initial investment divided by constant annual cash inflow, PBP. Then search for the two discount factors closest to PBP in year row of the life of the project in PV of annuity table. Now second step is you have to go to the table called PV of annuity table. In PV of annuity table, locate two discount factors. One discount factor should be more than PBP and the other discount factor should be less than PBP. Example, if PBP comes to 2.5, to locate two discount factor, one discount factor should be more than 2.5 and the other discount factor should be less than 2.5. In this way, two rates you will get. Less than 2.5 one rate and more than 2.5 another rate. So two discount factors you have located in PV of annuity table against the life of the project. After locating these two discount factors, apply the formula. The interpolation formula to calculate IRR is equal to RL plus discount DFRL minus PBP divided by DFRL minus DFRH into delta R. While doing the problem, I'll explain you about the full form of this RL. RL stands for lower rate. Two rates you have selected. Two rates you got from PV of annuity table in step 2. One lower rate, one higher rate. So take the lower rate plus DFRL, discount factor at lower rate, minus PBP, payback period, divided by DFRL, discount factor at lower rate, minus DFRH, discount factor at higher rate, into delta R, difference between the two rates. The difference between the two rates is called delta R. By applying this formula, interpolation, we can be able to get the actual IRR. First method completed. The second method, when the cash inflows are not constant, if in the problem you see the cash inflows are fluctuating, not constant, then this method should not be adopted. Now second method, step 1, calculate the average cash inflow to obtain fake PBP. Fake PBP means imaginary PBP. Because annual cash inflows are fluctuating, so first you calculate average cash inflow. After calculating average cash inflow, calculate the fake PBP. The fake PBP formula is initial investment divided by average cash inflow. Actual PBP, if you want to calculate, initial investment by constant cash inflow. Fake PBP, initial investment divided by average cash inflow, you will get fake PBP. Now step 2, search for the discount factor in PV of annuity table nearest to the fake PBP against the year equal to the life of the project. Now you go to the annuity table. PV of annuity table. In that, the life of the project, let the life of the project be 5 years. So in the line of 5 years, locate a discount factor which is nearest to fake PBP. Locate a discount factor which is nearest to fake PBP. Now take that discount factor and calculate the PV of cash inflow. Suppose the discount factor is 20%. Now our starting point is 20%. Find out the cash inflows. Find out the cash inflows at 20%. Now compare this cash inflow with the cash outflow. Suppose the cash outflow is 1 lakh and you got the cash inflow by using this discount factor 1,20,000. 1,20,000 cash inflow you got. Now you compare 1,20,000 cash inflow, 1 lakh rupees is the cash outflow. It is not equal. Now to reduce the cash inflow, PV of cash inflow, increase the rate. Earlier you have taken 20% rate. Now you increase the rate to 24%. Imagine. Increase the rate. When you increase the rate, the PV of cash inflow will come down. Earlier at 20% you got 1,20,000. Right? Now you have increased the rate to 24%. The PV of cash inflow reduced to 95,000. So two cash inflows you have. One cash inflow 1,20,000, second cash inflow 95,000. So one is more than 1 lakh, the other is less than 1 lakh. Now you have two rates. One rate 20%, another rate 24%. Now IRR lies between these two rates, 20% and 24%. In between that our IRR lies. So how to calculate the actual IRR? Interpolation formula is there. IRR is equal to RL plus PVL, present value at lower rate, minus PVCO, present value of cash outflow, divided by present value lower rate minus present value higher rate into delta R. This formula will be applied when annual cash inflows are not constant, and this formula we apply when the annual cash inflows are constant. Now these formulas we are going to apply in the coming problems where we have to calculate IRR. Now the differences between NPV and IRR. What is the relationship between NPV and IRR? First thing, the NPV and IRR methods are two closely related investment criteria. The techniques of NPV and IRR, the result of NPV and IRR are almost same. Many situations both will give the same decision of NPV as well as IRR. Both are time adjusted methods. Both are time adjusted means time value of money is considered in NPV and IRR. In case of independent projects, two methods leads to same decisions. If two different projects are there, independent projects, NPV and IRR will give the same decision. However, under certain situation, a conflict arises between them. In few situations, there is conflict. Conflict means NPV suggests A project, whereas IRR suggests B project. Both are giving different decisions. When this will happen, it is contended that the source of conflict between the two techniques lies in the different implicit reinvestment rates. The conflict will arise on account of the assumption regarding the reinvestment of intermediate cash inflows. The intermediate cash inflows, how they are reinvested, the assumption is different in NPV and IRR. What is the assumption? In NPV, the intermediate cash inflows are assumed to be reinvested at the cost of capital. At the cost of capital, that is the assumption in NPV. In IRR, it is assumed that the intermediate cash inflows are reinvested at internal rate of return, IRR. So that is the difference. That is the source of conflict. This is the source of conflict between NPV and IRR. That's all. So I have completed the theoretical part of this unit number 4, investment decisions. So in this I have explained you, in 3 videos I have explained you regarding capital budgeting, what are the cash inflows, what is the importance, what is the process of capital budgeting, incremental cash inflows, tax effect, uncertainty. Then I have explained about the techniques of evaluating a capital budgeting proposal. The techniques are two broadly classified, traditional techniques and modern techniques. All the 5 techniques I have explained. So before, my suggestion, before going for solving the problem, be perfect about the theory. And remember, in examination, you should not be prepared only from practical problems point of view. You should be clear regarding the concepts, because theory questions will also be asked in the examination. Inshallah, in the next video, I'll start the problems on these investment decisions. So if you're satisfied, give a like to the video, share my channel, give your comments. Subscribe my channel if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll start the problems on this capital budgeting in the next video.